The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello, good morning, and welcome to the Live Beginners Trading course here, presented to you by Forex.Academy. My name, of course, is your host, Robert Blackwell, and over the next lesson, of course, we'll be going through Protecting Capital and Risk Management, webinar number 6 of the Beginners Trading course. So without any further ado, let's move on with the following disclaimer. Of course, guys, there's always risk inherent when trading the financial market, so do be aware of the following disclaimer. And just a few pieces of housekeeping before we begin. Of course, this is a fully live interactive webinar. So what does that mean? It gives you the opportunity to ask questions throughout. You have the chat box located there on the right hand side of your screen. So as we go through the presentation, we'll be going through some charts, and of course we'll be discussing risk management and capital protection again in today's lesson. So you might have quite a few questions regarding to the amount of risk you should take. Post any of your questions there in the chat box. I'll be able to see them on screen and correspond with you. The live webinar is being recorded and will be placed into your members area once we have concluded. So we have that for revision purposes roughly around 1 hour after today's webinar. And the Q&A session at the end of this live webinar is, of course, a roughly 10-minute period where we can discuss any of the key topics with us together as a group. Okay, so let's move forward with today's lesson. And just to recap, we're on week 2, in the middle of week 2 here with webinar number 6, Protecting Capital and Risk Management. We just finished off there with the trading toolkit yesterday, where we discussed the market structures. All the markets in some shape or form are inextricably linked. We know that now. We then look to define that in terms of technical market structure as well, pricing in risks across asset classes, and looking at some basic technical analysis as well. So now that we know how to implement some technical analysis, of course, we'll be looking to trade more actively. And as we move across, then we need to focus on not making money, but protecting capital and risk management, which will be the construct of today's lesson. So how to stack the odds in your favor, how to apply a conviction level or status to your trades or trading positions. Risk reward ratios we'll be looking at as well in terms of defining profit, and the trade exposure on your entire account balance. Okay, so that might be something that you haven't really looked into before, but you can have an overall high exposure level on your account. And risk management itself in terms of outlining the amount of risk on your portfolio or on your open trade positions in their entirety. So that'll finish off today's lesson. Then we'll be going into much more of an active approach with becoming an active trader. Tomorrow, again, we'll be trading with 0.01 lots and getting heavily involved before moving on to the trading workshop this week. So it'll be a great finish, a practical finish to the beginner's trading course. So with today's lesson outline, what we'll be discussing is stacking the odds in your favor. Of course, as a technical analyst, you're looking to trade the probabilities, and that's what we do, stack the odds in our favor. Trading conviction, define risk. We'll discuss notional trade size with trading exposure on your account. Percentage trading, risk management, and the use of stop losses, of course, as our avoidance of risk. And the psychology of trading, again, always has to come back to our job as a trader, whether we are economic agents or human beings or not. We, of course, develop a level of psychological stability to your trade. So let's discuss then stacking the odds in our favor. So we like to formulate an approach to trading. We like to open a chart, we assess it with our technical analysis, we decide if we want to get involved or not. Is it a good trade? What's going on fundamentally? So if a potential trade exists, the first thing we then do is have a directional bias, okay? We want to get involved in a trade position. Why is that the case? Is there a trend? The first thing we need to establish is, do we want to become, of course, buyers and sellers? We don't just open a market and say, yeah, I'll buy that one, I'll sell that one, hopefully I'll make some money. So have a directional bias, and of course this is different to what we would call an individual bias, where you simply have an individual discretionary idea that one market is simply going to trade one way or another. It's different. Of course, we then, after confirming whether we want to go long or short, we stack the odds in our favor, of course, using the technical analysis. This will, of course, come in hand in deciding your trade decision. So you may look to use volume, you may look to use a Fibonacci retracement, you may look to use the structure and movement of the Japanese candlesticks. You stack the odds in your favor, and of course, if you have some fundamental analysis to supplement your trading decision, then albeit that is much better, of course. And then managing the trade. So this is something that is often overlooked because people think they've made the trade, they've placed their stop loss, and they've placed their take profit. Now that's fine if that is solely your style of trading and it works for you. But managing the trade is very, very important as well. So if we've made a trade and the market moves up to capture a good amount of profit, perhaps $100 or 100 euros in the trade, and the market starts to turn around, do we say to ourselves, well, we're just going to let that market trade the whole way back to zero for our stop loss for break even, or worse, even worse, to become an evidential small loser? That effectively is foregoing the 100 euros that you have on account. You know, it's open balance. It's still not reserved as profit, but your job as a trader is to manage the trade of that open balance as well. So moving stop loss up to capturing profit, managing the cycle of the life journey of that trade is very important, and that helps you book in as much profit as possible. Now, to be quite frank, that is our job as traders. That is our sole job as traders. Of course, it's a very educational pursuit. It's enjoyable trading the markets, but we often define one trader to another. The best trader is the one that makes the most money. I think we all agree on that. That's always the case. So our ability to book in profit is the most important, but we don't focus on the profit assumptions. We focus on our four-pronged approach here to developing and stacking the odds in our favor. So what we do is follow a structured path to profit. This will increase the probability of a trader being consistently profitable. Absolutely, that's the case. And then to bring that back into context, then stacking the odds in our favor. Many traders will simply focus on opening their account, starting at scratch for the day, trying to make as much money as possible. So that is the case, but when we often find, and this is the difference I would very much argue between retail trading and professional trading, so we want to get you guys thinking, like a structured trader, that we don't focus necessarily all the time on making as much money as possible. You often find if that's the case, well, it doesn't necessarily play out that way. What you focus on is start protecting your money, and then you start making money. So you actually focus on preservation of capital. Then you allow yourself to hit the best trades when they come around. You obviously manage those positions on the trades and look to book in profit, moving stop losses to profitable exits and so forth. And of course, then the evidential money comes and the consistency in profit making comes. Okay, so there's a fine line actually, not focusing in on the money made, but focusing on protecting the money that you have, preservation of capital, and then allowing yourself to involve yourself in the best trading opportunities. Trading conviction then, of course, and we have our trading conviction status here, a hypothetical one, of course, from 1%, 2% to 3%. Why do we define it as so? Well, because it's never good to take, for example, again, hypothetically, 30% risk trade, because that's crazy risk. You're effectively looking to grow your account balance. So what you're going to take 30% risk of your total account balance in one trade, that is not advised at all. And of course, that trade could be a very good winner. You may have made quite a bit of money, but if you continue to focus on that type of trading strategy, you are evidently going to take one whopper loser sometime or another. So we know and we accept that individual appetite for risk varies. We build a framework for risk guidance. Then we remember all trades should have a high level of conviction and trade with greater risk only when the trade merits it. So of course, every trade that you're looking to implement on your trading platform, the reason, of course, there is a reason why you're entering the trade. There should always be a reason why you're entering the trade, and there should always be a level of conviction to the trade. Now, what this simply means is, well, there are some trades that you want to take, and others are obviously the best, what you feel are the best technical setups. Perhaps two are very similar in technical setup, however, one has a lot of fundamental analysis supporting that trade. So you'll take both trades, of course, in different markets, but you may take 1% on one and 2% on the other. So trade with greater risk only when the trade merits it, and we use technical analysis, fundamentals, trade performance, and market correlations to supplement your trading idea. So you can see how we're starting to involve this, stacking the odds in your favor with technical analysis, fundamentals, trend performance. Are there other markets that are correlated that are performing in the same way? Perhaps they've already moved and this market is lagging. You often see these similar effects in gold and silver. So it's very important to trade each trade on its own merit and add a level of conviction status that you believe to the trade performance. In terms of our overall account, we outline a total trading exposure limit. So you might want to have only, let's say we have 8 open positions at the one specific time on our trading account. That's quite a lot. It depends how you're trading, of course, in terms of your term. However, if you have 8 open positions on your account and they're all 1%, that's fine, of course. They're going to be 8% of your account. If they're all going to be 2%, you're going to have 16%, and adversely, 24% if they're all 3% risk. So you can see how you're starting to really expose your overall account. If you have 8 3% trades open at the one time, 24% of your account exposed in risk is quite a bit. So do think about that as well. And we understand the notional trade size behind each assumption of risk. So, what is the monetary exposure behind each assumption of risk? If it's a 3% trade, is it effectively going to allow, or I suppose, allow the 3% risk to be a monetary value of 3% on my account? Is it correct? Am I trading 5,000 euros against the dollar, or am I trading 15,000 euros against the dollar? Or perhaps I've made a mistake and I'm trading 20,000 euros against the dollar. So you need to be aware of the notional trade size behind each trade. That leads us on then to defining risk itself. Well, risk, what is it? What is risk? Of course, the risk is the possibility of loss. Something we don't like to accept. Nobody likes to accept a loser, but it's part and parcel of the game of trading, of course. Pricing in this fear of capital loss. So it's not only the risk of loss, it's our attempts as economic agents or as traders, as market participants, to price in the risk, price in the fear of capital loss. And that's what, when you see equity markets sell off quite strongly, they're pricing in something there out there in the world. They're pricing in global conflict. They're pricing in Middle Eastern political shifts. They're pricing in Brexit dysfunction here in Europe. So they're pricing in all these different political and geopolitical risks that may affect the equity markets, or perhaps they're pricing in something more in terms of single stock equities and their performance. Risk is unavoidable in trading, as we can never guarantee future price movement, and that's always the case. Can absolutely never guarantee future price movement. Well, imagine, totally hypothetical again, imagine your favorite sporting activity. Perhaps some of us like to play football, we like to play basketball, perhaps we like to run in terms of sprinting, many different sports that are snowboarding. We like to involve ourselves in equestrian activities. So if you're passionate about snowboarding, is there an element of risk involved in extreme sports? Are you happy to assume this risk given your passion? Do you have a level of skill on the board that allows you to assume a general level of risk on the board? So that is no different than trading. Totally hypothetical, that it doesn't seem like a relevant conversation, but it is, of course, in terms of how you price risks as a person. And each person, of course, will have a different appetite for those risks. You might have some friends that prefer to ski and they'll go quite slow. You might have some other friends that are quite crazy on the board and have some experience, so they take on more risk. But obviously, you would hope their skills are, available to avail in their activity, and trading is no different. So that is why, of course, we define risk properly and we try to educate ourselves to better assume these risks. Risk and return are inextricably linked. The possibility of potential return rises with an increase in risk. Okay, so risk and return are inextricably linked. Does everyone understand that? So if you make more money on one particular trade, perhaps it's because you've taken more risk on the trade. If you take less risk, you're likely to make less money, of course. One way to manage the risks involved in trading is to acknowledge a positive risk-reward ratio. Now, what is a positive risk-reward ratio? Okay, a positive risk-reward ratio, you're looking to make more on one particular trade than you're looking to lose or define as risk. And we'll discuss that as we go through the lessons, so don't worry, we'll definitely go through some of these contextual points. Risk acceptance levels vary from person to person, but you should never trade with an uncomfortable level of risk. So you want to be comfortable in every market you trade, and you want to be able to take these risks. That's one of the main points I would say. Risk acceptance is both a financial and mental exercise. And traders can profit over the long term even with a 40-60% win ratio if they adopt a positive risk-reward ratio. So positive risk-reward ratio again. Let's jump into really defining what these mean for us, guys. Well, very simply put, a positive risk-reward ratio, it's when you're consistently, this is when you consistently make more on winning trades than you lose. So for example, you're looking to make 100 euros and you're looking to set your stop loss at 50 euros, minus 50 euros. So it's a positive risk reward. It's effectively a 2-to-1 risk reward ratio. Obviously, the benefit of this is the fact that you can have more losers in the markets, but effectively make profit overall. And again, if your skills are as such, this is recommended for you perhaps. If you have the technical skills to involve yourself in different markets where there's a positive risk reward ratio and that works for you, you will be profitable across a wide sample of trades. A negative risk reward ratio is when you consistently make less on a trade than when you win, than when you lose, of course. For example, making 50 euros every time you win and losing 100 euros every time you lose. You're operating a 2-to-1 negative risk reward approach. So, of course, it can be a function of trading. Of course, some traders decide to use it, particularly where there is more volatility, perhaps in the forex markets, where they're likely to get involved in that volatility. But again, you need to make many more winners, in fact, twice the amount of winners than you do losers to be profitable. So one impact is it can be damaging psychologically, because let's say, for example, you start a trading account with 1,000 euros. You follow this negative risk reward ratio. Again, I would argue that it's too much risk to be taking 50 euro losers on a 1,000 euro account just. However, if you operate this approach, you could effectively take 100 euro losers consecutively in a row. So you now have 700 euros in your account from your first 3 trades. How is that going to affect you? Well, of course, it's going to have a damaging psychological effect. So one point that I want to make, it is possible to make money from both approaches. However, be careful, all high percentage win rate strategies normally operate negative risk reward. So just be mindful of the potential consequences there. Okay. So let's go through in much more detail what these mean. Well, positive risk reward ratio. The potential aim is to make more from one individual profitable trade than to risk losing one on one particular trade. Okay. If our upside target again is $150, our stop loss financial exposure is $50. We have a positive risk reward ratio if we make more on the winning trade than we lose on the failed trade. This clearly means we can be less accurate and still make money once we stick to this type of risk reward ratio. So again, we're totally understanding this, guys, yeah? It's a positive risk reward ratio. We're allowing ourselves the possibility for each particular trade to make more money on the trade than we're allowing ourselves to lose. Risk acceptance. Okay, so let's have a few topical conversations here, and I'll start asking a few questions. Don't be afraid there to place some answers into your chat box if you'd like to answer some of these questions. Again, they're totally hypothetical. So what we have here is, how much do you think you should risk per trade? How much do you think you should risk per trade? Get some answers coming in here. It depends on the account size, 50 euros, 20 euros. Absolutely, so a wide array of different answers coming in there. The answer is different for everyone, of course, in terms of your appetite for risk and, of course, your account size. What is an acceptable level of risk per trade? So we're talking about acceptable levels now, moving away from monetary exposure. So perhaps we could try and answer this together. Well, hypothetically, let's answer, we say 1 to 5% maximum dependent upon experience and trade setup. Okay, so that's within it, most certainly within the realms of possibility, I would argue. Okay, so newer inexperienced traders know that you're at a bit of a disadvantage in terms of trading the markets compared to people or traders who have traded the markets for 2 to 3 years and beyond. Excuse me. So we'll choose 1 to 3% maximum risk. Experienced traders, 1 to 5% maximum risk. If a trader risks an average of 10% plus per trade, this means 10 losing trades back to back and it's game over. Don't make the same mistake again. Absolutely. So, this is one reason why it's not advised, of course, to take 10% risk per trade. Certainly in the professional world, or if you think of organizational or institutional trading, do you think they take whopper positions, in the markets where they're actually taking on 20% or 10% risk trades? Absolutely not. Absolutely not. Now, they will take massive short positions, of course, but hedge funds will be more likely taking those positions. And in a sense, hedge funds, of course, with the name, they're effectively hedging their position. So it's effectively, even if they're taking, let's say, a $1 billion short dollar trade, they'll be hedging that with other pairs, cross currency pairs, to effectively look to mitigate risk. So it's not a full 10% risk, of course, or much less. But effectively, no, that's not what we'd be looking to do in taking 10% risk on a trade. So let's discuss then notional trade size. Notional trade size is the overall position size value of a leveraged trade. And remember, CFDs, we're trading leveraged product here, guys, wherein a small amount of invested money can control a much larger position in the markets. Accurately calculating trade size is a crucial component of a risk management strategy. You should be acutely aware of the notional trade size for each market you trade. Okay, so let's look at the following table. I'll just leave this with you for 5 seconds, see if you can have a quick overview on the table here, because we have commodities, we have indices, and Forex markets as well. So can we see how significant it is to actually look across the different lot sizes and to see their value in terms of trading different markets, and why that might be very interesting to us as traders to look to understand notional trade size. So did we know that if we're trading one standard lot of currency, that is effectively 100,000 units of base currency? So we're trading one standard lot, a 1.00 lot of euro US dollar. Effectively, that is as if we have capital of 100,000 euros against the depreciation or appreciating dollar, of course, against the euro. So that's quite a large position, isn't it? Quite a large position. Whereas 1 million lot, okay, that makes a little more sense in terms of our trading account sizes. Perhaps we're trading 10,000, okay, and that's effectively our 0.10. And then our micro lot, again, very small trade size, simply 1,000 euros, okay, against the euro dollar, and that's as such. So of course, if we're trading, a fraction of that, 0.05, we are of course trading 5,000 euros against the dollar. That makes sense. Of course, that's for that is for our our Forex pairs. What if we're deciding to trade something else? Well, indices, of course, we are trading full index price. So the FTSE there is, what are we talking now? 7,690, say, as of today. So effectively, we're trading one index size of that figure, which is quite substantial. And again, fractions of that. Okay. Commodities as well. I mean, this is where it really gets interesting, guys. You know, did you know that effectively, if you're looking to trade a 0.01 lot, then you're trading 1 ounce of gold. So that is the amount that you're actually trading of gold. That is fine. It's absolutely fine, of course. And as this depreciates, this product, or this precious metal, of course, that we're all accustomed to, you're going to make money on that. You can see how one standard lot allows you to take such a huge size in the gold market. 100 ounces of gold. Guys, I would like to ask anyone, unless you have an account size of, 20,000 euros, do you think we should be trading 100 ounces of gold just at this stage? Especially, this is specifically because this is a beginner's trading course. I would assume that we're looking to learn the basics, of course. Absolutely not. So don't get involved just yet in these sort of trade sizes just yet in terms of your risk. Try and learn on much smaller lot sizes, of course, when trading. So that's your notional trade size, and it gives you an example and a real insight into what your exposure is, what you're actually trading, and the amount of value they're trading. Our individual exposure, then, let's take it back to our trading account, is the amount of capital you're risking in each individual trade. For example, 1% per trade of a $10,000 account, balance your exposure in $100 of your capital. So that's absolutely fine. Why is that fine? Because, well, if we have a $10,000 account and we evidently take a $100 loser, we don't feel the pressure there, guys. We don't feel the pressure. We're looking to grow the capital. We are, we're taking a good exposure to risk, and we're looking to benefit over the long run. Please note, it is very important that you predetermine your percentage risk per trade before opening a trade. So you want to know your monetary exposure before opening the trade. Now you can do that, of course, with risk management software, of course, which we use here. And obviously, knowing the notional trade size will help you do that. Overall exposure is the total amount of capital you're risking in all open trades combined at any one time. So we have an account, we have a traded account, we have 6 open trades, 1% risk per trade. We now have $600 of capital, total capital exposed to the markets. Okay, so again, that's fine. $600 of a $10,000 account, as long as these 6 trades are not in the same market, of course, or not in very, very strongly correlated markets. Let's say we're long the dollar and maybe 6 different currency pairs, not necessarily, individual trades. I would say they're very much the same trade to their own extent, because if the dollar takes a nosedive, of course, you're going to be exposed on that move. So this is what retail traders do not pay attention to. They stay disciplined on the individual trade risk side, often ignoring what their overall exposure to the market is if all trades go against them. So just take a minute to reflect on that. We are adding more in-depth insight to our overall exposure level on our account. Okay, overall exposure level on our account. It's very, very important that we do so. Okay, another example there, just to talk about the US dollar, is if you see movement in the US dollar and then people, some non-experienced traders will simply open up the platform, see markets move, and they'll place a buy dollar yen, they'll place a buy dollar CAD, a buy a long position in the Aussie, Australian dollar, US dollar, and they're all relative to the dollar. More consistently, of course, depending on the leg of what side, if it's the quote or the base currency, you might be taking hedge positions completely. So that's not something that we advise them to do, of course, and that is the point of education.